You don't need a six-figure salary, a trust fund, or a lucky break to build real wealth. All you need is a decision, one small, consistent decision, and the willingness to start before you feel ready. If you've been putting off investing because you think you don't earn enough, don't know enough, or it's not the right time, this video is for you. Hey, welcome back. Today, I want to show you something that completely shifted how I think about money and how investing as little as $50 a month done consistently over time can genuinely change the trajectory of your life. No business, no side hustle required. Just math, time, and a little bit of patience. Let me take you back a few years. I was earning a decent income, nothing spectacular, but enough. And yet, every month I'd watch my bank balance shrink and honestly have no real idea where it went. Coffee here, a subscription I forgot about there, an online order at midnight that felt necessary at the time. I kept telling myself, next month I'll get serious. But next month always looked exactly like this month. What actually woke me up wasn't a book or a podcast. It was a conversation with someone close to me who had been laid off. No warning, no cushion. One day employed, the next day scrambling. And they weren't reckless or irresponsible. They just never built anything under them to fall back on. I remember sitting there thinking, that could be me. I had been treating my paycheck like it was permanent, like it was just always going to show up. And in that moment, I realized how fragile that assumption actually was. So I made a change, not a dramatic one, a quiet one. The first thing I did, and this is the part no one makes exciting but everyone needs, was build an emergency fund. I started small, just 1 month of living expenses. That's it. No pressure, no huge target, just 1 month. Once I hit it, something shifted in me. I kept going. 1 month became 3, 3 became 6. And that little cushion, that safety net, changed everything about how I felt about money. Here's why this matters before we even talk about investing. If you invest without an emergency fund and something goes wrong, job loss, a medical bill, a car that decides to quit, you'll be forced to pull that money straight back out, possibly at the worst time, possibly at a loss. That's how years of progress can evaporate in a single bad month. The emergency fund isn't boring, it's the foundation that makes everything else work. Okay, now let's talk about the part that actually blew my mind. Say you invest just $50 a month into a low-cost index fund. We'll assume an average annual return of 10%, which historically is roughly in line with long-term stock market averages. Of course, returns aren't guaranteed, markets fluctuate, and there may be fees and taxes depending on your situation, but let's use this as our working example. After 2 years, you'll have put in $1,200 of your own money. Your portfolio? Roughly $1,330. That's just $130 of growth. Not exciting, I know, and that's intentional. I'm not going to oversell the beginning, because the beginning is hard. You're doing most of the heavy lifting. Your money hasn't had time to start working for you yet. But here's where it gets interesting. After 10 years, you've contributed $6,000. Your portfolio? Roughly $10,327. Over $4,000 of growth you didn't earn at work. After 30 years, that same $50 a month grows to around $113,000. And after 40 years, nearly $319,000. From $50 a month. Now imagine if, as your income grows, you gradually increase what you invest. Let's say you start in your 20s at $50 a month. In your 30s, after a raise or two, you bump it up to $150 a month. In your 40s, you're in a stronger financial position. You increase to $300 a month. And in the decade before retirement, you're investing $500 a month. Assuming the same 10% average annual return throughout, you could enter retirement with a portfolio worth over $700,000, possibly exceeding $1 million, while having personally contributed somewhere in the range of $120,000. The rest? That's compound growth. That's interest earning interest. That's your money quietly doing the work while you lived your life. This isn't a fantasy, it's arithmetic, and arithmetic doesn't lie. Now, I know what some of you are thinking. This sounds great, but is now really a good time to invest? I hear this constantly, and I get it. Turn on any news channel and there's something to be anxious about. Inflation, interest rates, recession fears, political uncertainty, it never really stops. So people wait. They think they'll invest once things calm down or the market makes more sense. The problem? People have been saying that for decades. In 2008, the financial system looked like it was collapsing. In 2020, markets plummeted and everyone braced for years of recovery. And yet, if you stayed invested through both of those moments, your portfolio recovered, and then some. Because here's the truth, no one knows what the market will do next. Not analysts, not economists, not the people on financial TV. If they did, they wouldn't be on TV explaining it. They'd be sitting on a beach somewhere. Which means trying to time your entry perfectly isn't a strategy. It's procrastination dressed up in smart-sounding language. There's a phrase you'll hear a lot in investing circles. Time in the market beats timing the market. What that means is, getting started and staying consistent almost always outperforms waiting for the perfect moment, because by the time things feel safe enough to invest, prices have often already bounced back. The best time to start was 10 years ago. The second best time is today. And then there's the third thing that holds people back, the belief that investing is just too complicated for them. If you've ever gone down the rabbit hole of investing content online, you know the feeling. You search how to start investing, and suddenly you've got one person telling you to buy individual stocks, another saying crypto is the future, a third one with a 47-step spreadsheet system, and you close the laptop more confused than when you opened it. That's not your fault. That's the noise. Here's what I've learned after helping people navigate this. For most people, a simple long-term strategy, a low-cost, diversified index fund invested consistently every month, is not just good enough, it's often better than what many professionals do. You don't need to read earnings reports, you don't need to follow market news, you don't need to stare at charts. You need to open the right account, choose a simple, diversified investment, set up an automatic monthly contribution, and leave it alone. That's the whole strategy for most beginners, and the reason it works is precisely because it's simple. Simple things get done. Complicated things get abandoned. So here's where I want to leave you. If you've been waiting for permission to start, this is it. You don't need more money, you don't need more time, you don't need the market to cooperate. You just need to take the first step while the voice in your head is telling you to wait another month. Because the future version of you, the one who's looking at a portfolio that's been growing quietly for 10, 20, 30 years, they're not going to remember the month you started, but they'll absolutely feel the difference between starting today and waiting another year. Start where you are, with what you have, and let time do the rest. If you found this helpful, subscribe, because I put out new content every week designed to make personal finance actually feel manageable. See you in the next one.